pay attention. Should we start?
Yes, sir.
Good. You are starting. Now, this is your question. Your questions are going to be structured in this way. Question one, final account. It's compulsory. You finish all, you solve all, you attempt all. Final accounts. Then question two. Formally, it was question one, final account. Question two, bank reconciliation statement. Question three, correction of errors. So you choose between then question five. There were four theories. Okay, there may be depreciation. So these were constant. This is constant. This is constant. Theories is constant. Then between 2, 3, and 5, two questions will be brought to make the entire questions 4. So you solve all. So between former they were bringing in depreciation, but now they restricted it to only this, and they've sent this depreciation to even accounting and finance and accounts, but still they don't ask them sometimes. They don't ask them on it sometimes. So that is for your information. Okay, let's continue. Okay, so now, when we're doing correction of errors, I said Alice, right? You remember I said Alice?
Yes.
We are going to
Alice.
use Alice here.
Yeah, Alice.
Alice stands for what? Assets, liability, income, capital, and expenses. And I said
Okay.
the first A and the last E, where do they reflect? Where are they written on
Debit.
Debit side.
the T
Debit.
account?
Debit side.
So the first and the last are on the
Hey.
debit side. The middle three are on the credit side. And I said we add
Oh,
expenses, costs, losses. They are written on the debit side of the account. And we have income, we have gains, we have profits right on the credit side. So we write the income, gain, profits on the credit side. We also write capital and or equity on the credit side. Now, as I said, in accounting, there is something called recognition and measurement. Every transaction in accounting, it must be recorded under recognition is talking about recording it. Let me basically say recording it, or literally say that measurement means you are costing it or you are valuing it. So whatever transaction which occurs, you have to record it under the Alice, one of the 5. It must fall here. That is why when we were learning, I'll ask you sales. What does it bring in the Alice? You said income. Where is income? Credits, meaning sales goes to credits. Discount received. What does it bring? Income. So it goes where? Credits. Profits, gross profits, net profits. Where do they record? Where are they recorded in the T account? Credits. Expense, salaries, sundry expenses. I was asking you under the Alice, where do they fall? You said it's fall under expense. So expense, what do they fall? You said on the debit side. That is what you are trying to do here. So let's go to the trial balance on the left. For now, another par, a sole trader. All the figures you are looking at, are you paying attention? Are you paying attention?
yes, sir.
Yes, sir.
All the
Yes.
figures you are looking at, debits, credits. All the debit figures, they are either assets or expenses, cost or losses. All the figures you are looking at on the credit side, they are either liability, they are bringing income, gain, they are profits, they are capital, or they are equity. That's how they are. Every transaction must fall under the one. So let's look at it. Now let's start reading. So if this is a question and you are presented with it in the exam hall, the first thing you do you go and write the entity's name. You write the entity's name. The first thing, you write the entity's name. What's the entity's name?
Nana Dapa.
Nana Dapa. You
Nana
write it here.
Dapa.
Nana
Dapa.
Dapa. You double underline neatly. Then you go to the requirements. What's the first requirement? Quick.
Statement of profits and loss.
Prepare a statement of profit or loss. So you write statements of what?
Profit
Profit
or
or
loss
loss,
for the
not
year
end,
ended, or
or loss for
for
the
the year ended 31st December 2020.
year ended 31st December
2020.
You write it. The question says prepare a statement of profit or loss. Then you write statement of profit or loss for the year ended 31st December 2020. Then you can bring 3 currency signs, which is okay. One here, one there. Let me write it this way. There are 3 currency signs. This is the Ghana cedi. This is for workings. Then we have one here, which is the debit. Then we have another there, which is the credit. Are we good? Are we good?
Yes.
Then pay attention. You go with a pencil and a ruler. Then you draw each of them. You draw, or what's this? Okay. Land, your ruler, you match it against the figures. You do this. You don't have time in exam, so you have to do all this before you start. Otherwise, when the figures cross over to another edge or to another figure and you record the wrong figure, that's the end. You know that you're going to rewrite it again. Or you'll be rewriting the exam, the paper. Then it will take you 1 year before you rewrite it. You don't know where you do well. You don't know where you not do well. Hold on. So here, I'm going to explain everything, so pay attention. So use your pencil. You do this. Do you get it?
Okay.
You use your pencil. This is what you do. Hey, where is this thing? Okay, let me write again. So another part is gone off. Okay, so this is what we are going to do. Pay attention. We are going to prepare 3 levels of profits. 3 levels. Have you posted in the group that you are preparing income statements? We are going to prepare 3 levels of profits. And the 3 levels of profits, the first one, we are going to prepare the gross profits. The gross profits. And that is, we will find sales minus cost of sales. Then the second profit, we will find total income. We will find the gross profit here, which is the GP. We will add other income. And then the third profits, which is the final profit for the P&L. This is for the P&L, profit or loss. We'll find the net profits or loss. We'll bring the total income, which is the TI. Then we will less operating expenses. So this is going to be the guide. Are you following?
Yes, sir.
Are you following? This is going to be the guide. So we are going to find 3 levels of profit. So having written the title, this is my answer booklet, the first page. I'll go to my question and rule the lines. Use pencil, rule all the lines. I've not even started reading. Then I'll now start. The following trial balance was extracted from the books of another power, a sole trader on the 1st of 2020. Land, equipment, accumulated depreciation, inventory. So as I said, the Alice, right? And we did a T account. A and E here, L, I, and C there. Everything on the debit side. Everything on the debit side. Let me write the debit side so you guys can see it. Everything on the debit side, right? It's falls under an asset or an expense. And we say we write expense, costs, or losses on the debit side. Everything on the credit side, liability, income, capital, it falls under one of them. So let's go. So I have here land. Land is an asset, debit. T account. Equipment, asset, debit. Accumulated depreciation on equipment. It is not a liability, but it's treated like a liability, but we say it's a contra entry. Inventory is an asset, debit. Receivable. So when you have something like this, receivable, like the receivable figure you are looking at there, let me write it here. Let me write it here. So you could see we have the receivable figure, which we see there. We see we have receivable figure of 4. We have receivable here. And what? Payables. And we have the debit side here, the credit side here. We have 248, 400, and 208, 760. So the receivable go for the debit side. The payable goes to the credit side. Do you get it? Do we get it?
Yes, sir.
So receivable figure is the amount of money the business is to be paid by customers who owe the business. So receivable means the business is going to receive money from customers. Those people, customers, they owe the business. Payable is the other way around, where the business will pay suppliers. Are you good? Another name for inventory above receivable is called stock. We have the bank and cash balances today. We've done a lot about bank and cash during the correction of errors. Allowance for doubtful debt is on the credit side. It's a provision. So it's treated like a liability kind of, but it's not an actual money for liability, but it's treated as a provision. I'll explain it. Business rent is the rent paid by the business for the premises it occupies. It occupies, sorry. Purchases is on the debit side. It's an asset. Business rent is an expense. Allowance for doubtful debt is similar to, let's say, it's kind of a liability, but it's a provision. So it's a liability. Accumulated depreciation too is like a liability, it's a provision. Then we make use of the bank and cash is an asset. As I said, receivable is on the debit side, is an asset. Payable is on the credit side, is a liability. We go to purchases, is an asset. It's an expense on the debit side. Returns. Returns, so we have two figures here. We have inwards and outwards. The inwards is the debit, the outwards is the credit. We did something like that similarly when we're doing the correction of errors, where they use the name sales returns. And I said sales returns is the opposite side of the sales. So it is sales is on the credit side, and the debit one is called sales returns or return inwards. Then the one on the credit side is the opposite of the purchases. Purchases here is on the debit side. Then the purchase returns is on the credit side. So the one on the credit side is used against purchases. Then for the sales, we have sales here on the credit side. We will use the one on the opposite side, the returns on the opposite side, credit, debit side, to compare or to adjust the sales figure. Are you okay?
Yeah.
Are we okay?
Yes, sir.
Only one person?
Yes, sir. Yes, sir.
Yes, sir.
I want to teach some people, so let me be quick. Then we have distribution and advertising. They are also expenses, debit side. I know this because of the Alice. So long as it's on the debit side, it's either an asset, an expense, a cost, or a loss. It's on the credit side, it's a liability, it's an income, it's a gain, it's a profit, or it's an equity. Discounts. We've done discount before when we're doing the first correction of errors. The one on the credit side is always the gain. It's always the gain. It's always the income. It's always the gain. Then one on the debit side is an expense. Discount allowed. The one on the debit side is called discount allowed. The one on the credit side is called discount received. If you think you will forget no one. You know we have allowed and received. Then the received is on the credit side. So always the received is on the credit side and it's a gain. If it's on the credit side, it's a gain. So discount received is a gain. If you know the one on the credit side is the received and is the gain, then the one on the debit side is the allowed, is the expense or the loss. Are we good? Are we good?
Yes. Yes, sir. Yes.
Communication is an expense. Insurance, expense. Wages and salaries, expense. Sales, credit is an income. 10% long-term loan is a liability. The L is the L. Loan interest paid is an expense. Bad debt is an expense. Drawings, it's an expense, but it's used against capital. Capital itself, Alice, C is on the credit side. So you could see they all follow the Alice, the element of the financial statement. So if you don't, any of these, if any of it doesn't fall under the Alice, you cannot prepare the financial statement. And their totals, they are the same. So it means that that's why it's called trial balance. They must balance, they must be the same. So even if they are not balanced, we would say there's an error. We have to go and calculate for it and fix the in. All right. So after that, you go to the additional information. You go to the additional information. Additional information says the additional information, another name for the additional information is called footnotes. The additional information is to add. The additional information is to add or subtract. That's the main work. You either add what's in additional information or subtract what's in additional information from or to what is in the trial balance. So the additional information items, I, and IV, they are either to be added to what is in the trial balance or subtracted from what is in the trial balance. Are we good?
Yeah.
All right. So the inventory count. We have inventory. The inventory here is I, right?
Yes, sir.
Can you see my screen?
Yes, sir. Yes.
So inventory is I, right? So I'll go to inventory in the trial balance and I'll write I. So that when I'm solving and I see the inventory in I, I'll come to the I in the additional information and read on another thing about the inventory. The one in the trial balance is called opening inventory. The one in the additional information is called closing inventory. Look at the dates. Closing, 31st December. Closing inventory. Do you get it?
Yes, sir.
So it says the inventory count as at 31st December 2020 show the closing inventory. Closing inventory. Some questions they will not state it. You should know the one in the additional information is the closing inventory. 84,780. Obaya has agreed on an annual rent of 80,000 with his landlord. So rent 80,000. When I go to the trial balance, I'll set for rent and I'll write II, footnote what? II. So when I'm solving and I get to rent, when I'm working and I get to rent, then the rent figure there will tell me that well, I have another issue on rent in the additional information. So I write against it. I have not started the work. I'm not planning. I'm doing planning. I'm planning my work. Once I start, I know I'm going far. I'll be able to do it than someone who doesn't know all this. Oba has agreed on an annual rent of 80,000 with his landlord. So when I get to business rent, there's an additional information there. Included in the insurance above is an amount of 5,500, which relates to 2021. Including the insurance above is an amount of 5,500, which relates to 2021. So rent, where is it? Insurance, where is insurance? Here. So I. So when I get to insurance, there's one on it in the additional information. IV, Obaya makes 5% general provision on the receivable balance at the end of each financial year. Obaya makes 5% general provision on the receivable balance at the end of each financial year. So general provision, we have what is called specific provision and general provision. General provision is always in percentage. So general provision. General provision. General provision. General provision is always in percentage. Then we have specific provision. It is always an amount. So stay there, let's say 500. Do you get the difference?
So can you come again?
I'm saying general provision, like in the question, is always in percentage. Then a specific provision, they will give you to you in an amount, like a figure.
Okay, sir.
Then you compare it with, whenever you're given a general provision like the IV, it goes in line with the allowance for doubtful debts, IV. So it writes against IV.
Oh, okay.
So whenever you are solving it and you see general allowance for doubtful debts, know that there is an information on that in the footnote. Another thing, when we say that, are you writing?
Yes, sir.
You don't write. When a question says that, pay attention. When a question says that allowance for doubtful debts, allowance for doubtful debts, it is the same as provision for doubtful debts. It is the same as allowance for is the same as allowance for receivables. It is the same as provision for receivables. Do you get it?
Yes, sir.
So in this question, they said general provision. And the general provision is also the same as allowance for doubtful debts. Let me put it that way. Are we okay?
Okay.
So allowance for doubtful debts equals provision for doubtful debts equals allowance for receivables equals provision for, they are all referring to the same thing. So here they've interchanged the names, allowance for receivables, allowance for doubtful debts, and the footnote type, they said 5% general provision on the receivable, which is provision for receivable, which is the same as I've written here. Are you getting it?
Yes, sir.
Now we go to depreciation. So you write it. Depreciation should be charged as follows. Let's see what we have for depreciation. Depreciation, we have land, right?
Yes, sir.
We have land to be how much? So we have land. So depreciation, you go to land and write a footnote against it. Let me do it this way. So depreciation, we go to land. So land, V. So where is land? We have land here. I write V. And we have equipment. So I write V. And we have what? The inventory, I. The allowance for doubtful debts is IV. Then the business rent is what? Which footnote number?
I.
Then what else?
Insurance.
Insurance. Insurance is what? I. And they said 5% general provision. So I've done all these workings. Now I'm about to start the work. I believe you are writing.
Yes.
Watch. Now. Items in the trial balance, they are treated once. Items in the trial balance, they are what?
Treated one.
They are treated once. Items in the trial balance are treated once. So right, items in the trial balance equals treated once. Either in the P&L or balance sheets. So the items in the trial balance, land to capital, they will appear once. They will appear in the P&L or they will appear in the balance sheet. Are you getting it?
Yes.
Then items in the footnotes. The footnote is the additional information. The footnote is the additional information. They are treated twice. P&L and balance sheet. Items in the trial balance, they are treated once. Either in the P&L or balance sheets. Items in the footnotes, treated twice. P&L and balance sheets. Are we good?
Yes, sir.
Have you written them down?
Yes, sir.
Am I teaching only one person in the class?
No, sir. We
Some
are
of you are
here.
sleeping. I hear your voice and I feel like vomiting. Yeah, sir. No, sir. You are sleeping. You are writing paper tomorrow and you are sleeping.
Fine.
So I'm now ready to start my work. Now, let's go back to the profits. Levels of profit. What's the first level of profits?
Gross.
Gross profit.
So we are going to find a gross profit. How do we find a gross profit?
Sales
Sales
minus
minus cost of goods.
sales.
So I'll begin. Sales. What's the sales figure?
I think 909,360. 909,360.
What's the sales figure?
909,360.
But do we have to make any adjustment to sales? Yes. Returns, right?
Okay.
Because they sold some items and some items were also returned. So what's the sales figure?
909,360.
900. You can write it. Let me write it just here. 909,360. Then I'll say less return inwards or sales returns. Return inwards is the same as sales returns. So why am I lessing? Sales, on which side of the account is it? Is it on the debit or credit side?
Credit.
Credit side.
Return inwards, is it on the debit or credit side?
Credit.
Hey,
Debit side.
Wait, debit.
I said sales is credit, so we'll do the opposite side for the returns. So return inwards is on the debit side, then sales on the credit side. So now, and I told you that whenever an item is moving from one side of the account to the opposite side, will it go and add or subtract?
Subtract.
So that's why I'm saying less return inwards, because we are moving the return inwards, which is on the debit side. We are moving the return inwards, which is on the debit side, to join this return inwards. We are moving it from that side here. We are moving it from here to join the sales on the credit side. So because the return inwards is the one moving, it will go and subtract from the sales on the credit side. Do we get it?
Okay.
So we are having 16,600. What do we have? What do we have? Quick, quick, quick. I don't have time.
892,706. 706.
This figure is called net sales. Whenever you hear net sales, net anything in accounting, what it means is this, or net or in finance. It means net sales means the word after the net, which is sales in this circumstance. Something has been taken out from it. The balance of that, the balance on the sales is called net sales. So we had sales. Something which was called return inwards was taken out from it. The balance of the sales, which is the 892,760, this is called net sales. So whenever you hear net sales, it means the word sales, something was taken from it. The word sales is an amount of money. Something was taken out from it. The balance is called the net sales. Do you get it?
Yes.
Okay.
Net profits. Who can tell me what it means? Quick, 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 quick. I don't have time. Quick. Did you understand the net sales explanation?
So we do.
So net profit, what does it mean?
Means something has been deducted from the original profits.
The balance of the profit is called net profit. Do you get it?
Okay. Yes.
You'll be using a lot too. You'll be using a lot. So just bear in mind, don't forget that. When you were doing statistics in 1100, you were doing, what's the name? net export, net import. Is
Hmm?
that correct? Didn't you do, this is economics.
Economics.
You are doing net export, net import, right?
Yes, sir.
It's the same concept. It means the export, something was taken from it, the balance is called net exports. That's it. Let's continue. So this is net sales. So we are to find sales minus cost of sales. But because the sales, there is an adjustment on the sales. You have to make the adjustment before we come in with the cost of sales. Cost of sales in the Alice, where does cost fall in the Alice?
Credit side.
I'll
Debit
give you a packet. Check what the Alice I drew. I said, where does cost fall in the
debit side.
debit side? Because cost is the same, it goes with what? Expenses, right?
Expenses.
And losses
Yeah.
is on the debit side. So sales is on the credit side. Cost of sales is on the debit side. And we are moving the cost of sales to go and join the sales. So what will the cost of sales become? Positive or negative? Sales is on the credit side.
Yeah.
Cost or expense, so cost of sales is a cost. It's on the debit side. It's a direct expense. It's on the debit side as an expense. We are moving the debits to go and join the credits. Will the debit item become positive or negative?
Negative.
That is why we are subtracting the cost of sales from the sale, because it's going to change position. It's moving from the debit side to the credit side. Do you get it?
Yes, sir.
So we say less cost of sale. Less means subtract it. Why less? Because cost of sales is an expense. We will eventually move it to join the sales on the credit side. So if you move it to join the credit side, debit changing to the credit becomes negative. That's why we are lessing it. Are you good?
Yes, sir.
But the cost of sales it's an umbrella, it's a collective cost. There are some individual costs there. First, you begin with the opening inventory. Whenever you are starting a business, a new year, don't you begin with the inventory from the previous year?
Yes.
So if you close your business on 31st December 2021, 11:59 p.m., 31st December 2021, we just have 1 minute, right? 31st December 2021, 11:59 p.m. You just have 1 minute to add to the 11:59 to make it 12 a.m. And then you get into 1st January 2022, isn't it?
Yes.
Yes, sir.
So the closing inventory for the previous year becomes the opening inventory for the new year. Is that correct?
Yeah.
So
Yeah.
when you begin your business, you start with the opening inventory. And the opening inventory is the one in the trial balance. How much is it?
Balance. 97,504. 640.
That's what you begin with.
Ah,
Hey, some
but
people are
I
leaving
don't
the
have
chat
the
too.
clue.
The way I've taken my time, some people are leaving. I believe they are okay. 97,540. Then, are you going to sell only this a number of worth of items the whole year?
No. You
What do
buy
you do?
more. You buy more.
You buy more. So
Or
purchases.
restock.
Restock, yeah. Purchases. What's the purchases figure?
500. 580,400. 400.
Then what adjustment do you use against the purchases? If there is return inwards against sales, what will be used against purchases? If there is return inwards against sales, what will be used against purchases? With sales, you sold some items, some customers, you sold 500 cedis to some customers. And the customers said that the items they bought, which was 500 cedis, 100 cedis is bad. some of the items, 100 cedis are sports. So how much did you actually sell to them?
400 cedis.
How did you get the
400 cedis
400?
because you subtract the 100 from the 500.
Yeah. So this is your sales. This is your return in what? This is your net sales. That's what we have done here. Do you get it?
Yes, sir. Yes, sir.
Yes, please.
So purchases too is the same thing, just as sales is. So is purchases. So purchases, you have bought some items, some were bad. You have to return some, isn't it?
Yes.
Yes, sir. Yes.
So we go to the next one, returns. Return the one on the credit side. Purchases is debit. So always look at purchases. Where is purchases? Look at where purchases is. It's debit, right?
Yes, sir.
Then it will take the returns on the credit side so that they will subtract. If you bring the
Not return
16,600, you
out.
add. It's wrong. So you say less. Now purchases is on the debit side, returns is on the credit side. So less return outwards. It is also called purchase returns. Why are we lessing the return outward? Because the return outward is on the credit side, and we are bringing it to the debit side of purchases. Do you get it?
Yes, sir.
So what's the
Yes,
return
sir.
outwards? 2840. You less it, so you subtract. Are you good?
Yes, sir. Yeah.
I want to use a simple way you can remember. I don't want to make it so complex. When I subtract return outwards from purchases, what will be the name of the figure? When I subtracted the return inwards from sales, what was the name of the figure?
Net sales.
When I take out the return outwards from purchases, what will be the name of the figure?
Net purchase.
Net purchases. Do you get it?
Yes.
But because of the time, I will not break it so down. Otherwise, it will be so many for some of you. So let's continue. Is there anything else which will affect purchases? No. No. Now we will come in with closing inventory. What is the closing inventory? Footnotes.
84,780.
You less it. Hold on, let me do this for you. All these, add all these. Mm-hmm. Mm-hmm. Yes, 97,540 plus 580,400 minus 20,840. What do you have?
657,100.
600 and what?
57,100.
This is called cost of goods available for sale, or COGAS. Then you bring your closing inventory. What's the closing inventory? 84,780.
84,000.
So this is what you should know. The opening inventory, it is added. The closing inventory, it is subtracted. Don't change it. Opening inventory is plus. Closing inventory is negative. Are you okay?
Yes, sir.
What do you have?
572,320.
You can write it on the same line. This 572,320 is called cost of sales. This is the cost of sales. Some books too, they call it cost of goods sold. COGS. Are you getting it?
Yes.
Yes, sir.
Now watch. This 572,320, I can also write it here. I can also write it here. 573 572320. But when I write it here, it is still on the debit side, it's positive. And
Sure.
this figure here is the cost of sales. So when I move it to the right-hand side, when the debit crosses to the right-hand side, it becomes what? Negative.
Negative.
So that is the cost of sales there. And because I'm going to subtract, I will underline it. And it says less cost of sales. So the cost of sales figure I got, it said I shall subtract it, I shall less it from the net sales. So what do I have? Quick, quick, quick. Mm-hmm.
319,440. 319,440.
So look at, what's the first level of profit we need?
Gross profit.
It should be what? Sales minus cost of sales, right?
Cost of, yes, sir.
Have we done that already?
Yes, sir.
So we found our gross profit. What is our gross profit? The figure we see here is called gross profits. Have you found our first level of profit?
Yes, sir.
Have you found our first level of profit?
Yes.
Yes, sir.
What is the second level of profit?
Total income.
How do you find total income?
Gross profit
Gross
plus other
Plus
income.
other income.
other incomes.
So we found our gross profit here. What do we do? The other income, are we adding or subtracting?
Add.
Why are we
adding.
adding? Who can tell me why? Joe, keep quiet. Who can tell me why? Eh, T
Because there
accounts,
are
T
other source
accounts.
of profit.
Because what? T account, Alice. Because gross profit and income, they are on the same side of the account, credit side. So if you are bringing more income to the side where profit is, you have to add. Do you remember that?
Yes, sir.
Hey, only one person do that. Only one person does. Class, do you remember that? Hey, should we continue or we
yes.
should pause?
Yeah,
Should we continue or we should pause?
So let's continue.
Let me see those in the class. Hadassah, Ethel, Kriya. Okay, let me finish. Because I've started, I'm recording, so let me finish it. When I finish, I'll share it in the group. Okay, other income. We'll go to discounts, right? We are on discount. Other income, look at discounts. We have discount received. Discount received on which side of the account is it? The
Credit.
trial balance, which side is it?
Credit.
I said master one.
Right.
Master one is on the credit side.
Yes.
So you add it.
Okay.
You add this. We can also have rent received, income. Income received, income. Commission received, income. They are all interest received, investment income. You can have investment income is an income. You add all of them. So rent received, income. Interest received, income. Commission received, income. Are you good?
Yes, sir.
Look at this one. Look at this one. Look at this question. Look at this one. Look at this one. See, we have rent received. I've added it to other income. Income from investment. I'd have added it to other income. Are you getting it?
Yes, sir.
So you see here, We have premises. Premises here stands for building. It stands for building. So it's a non-current. We have bank, we have sales, we have receivables. This carried in what? Pay attention. Carried in what? If I have had carried in what in my question, the one I'm solving, this carried in what is an expense. So I'll come and add it to purchases. So I'd have had purchases, add carriage inwards, less return outwards, because they are all on the debit side. Have you seen it?
Yes, sir.
So we have carried inwards and outwards. So if the question I'm solving there, I have had carriage inwards, I would have added, after writing purchases, I would have added carriage inwards. Then I will less the return outwards. So you see this question too has returns. Have you seen it?
Yes, sir. Yes, sir.
Uh-huh. Then here it has rent received. It will come to other income. Income from investment. I'll come and add it to other income. Are you good?
Yes, sir.
I should have solved this one because this one is loaded. Okay, but it's fine. It's
Yeah,
fine.
yeah, so,
It's fine, but you can still do it. Discount. This is an investment. So whenever we get to wherever we have to be, I'll come and speak on it here. Are you okay?
Okay.
So this rent
Yes.
received income from investment, I would have added them, all of them, to the discount received. This is the discount received. I'd have added them to the discount received. So 1, 2, and 3. They would have all gone to other income.
Oh, okay.
But here in the question we are solving, we have only one, which is the discount received. So let's show you if there's any other one.
So,
After you find a discount received, if there is no other interest received, rent received, income from investment, or whatever, the next thing is you go and check the allowance for doubtful debts. This guy here, this man, you go and check him. You compare this guy here with the footnotes provision. This. You compare this and this. Now you find 5% on the provision. So you find 5%. Is that 5% provision? So 5% times. What is the receivables figure?
the receivable figure, 248,400.
So 5% of 248,000 what? 400. What do we have?
$12,420.
What?
12,420.
So we are comparing the figures. These two figures. You do it on a question paper. These two figures. At the beginning of the year, they said they estimated 22,500 being monies or debts owed by customers which they may not pay. Let's say which they won't pay. Then at the end of the year, the figure is now 2,420. What do you think has happened? Has the figure increased or decreased?
So please can I ask the question again?
At the beginning of the year, the estimate allowance for doubtful debt is an estimate of debts the customers who may not pay in the year, right? They estimate debts which customers will not pay in the given year. So this year, they estimated at the beginning that it is 22,500 for this year. And at the end of the year, the 22,500, it ended up to be 12,420. So I'm asking, has it increased as at the end of the year, or it has decreased as at the end of the year? Look at the figures. Look at the figures. Don't let me give it to you wherever you are sitting. Look at the figures. 12,022,500 has, from the beginning of the year, allowance for receivables. The trial balance information is beginning of the year and during the year figures. So at the beginning of the year, it is 22,500. The footnote information, which is additional information, they are the end of year figures. So they said provision for receivables. At the end of the year, it was 12,420. Has it increased or decreased as at the end of the year? Has the 22,500, has it increased or decreased as at the end of the year?
Decrease.
It has decreased. It's 22,500 at the beginning of the year. As at the end of the year, it is 12,420. It has decreased. So if it has decreased, by what amount has it decreased? Find a difference. Find a difference. 22,500 minus 12,420.
10,080.
10,080.
What?
10,080.
What it means is this. The estimated 22,500 wouldn't pay during this year. But they realized that as at the end of the year, it has decreased to 12,420. It means that this 10,080 are monies the customers they estimated will not pay have come to pay. Have come to pay. Are we good?
Yes, sir.
So has the business gained money or lost money?
Gain.
So if the business has gained money, which side of the account do we record gains? Debit or credit?
Debit.
Alice, look at the Alice.
Credit.
Picture the Alice.
Credit. It's
Credit.
credit.
We record it
Income.
at where the income is recorded, right?
Income. Yes.
Yeah,
So
credit.
we will say decrease in allowance for receivable into bracket 22,500 minus the 12,420. How much is it? 10,080. It's a gain. If it's a gain, you add it to other income. Are we good?
Yes, sir.
Decrease in allowance is a gain because they estimated that 22,500 will not be paid by the customers. By the end of the year, the 22,500 has decreased to 12,420. It means that those customers they estimated who were owing 22,500, they've come to pay, some of them have come to pay 10,080. That's why it has decreased to 12,420 at the end of the year. But if it were the opposite side, where it is 22,500,
What are they?
and at the end of the year, it has increased to 30,000. It means that they are losing more money into receivables. It means that they are giving more credit out. They give out more credit. And if you give out more credit, you are losing money. Are you good?
Yes, sir.
And that will be like 7,500. So here, if it were 22,500 in the trial balance and the footnote is were 30,000, it means as at the end of the year, it has increased from 22,500 to 30,000. Here we will say increase. If it's an increase in the allowance, the business has lost 7,500 that year to other customers. Are you getting it? And if
Yes.
it's a loss, where do we record losses in the T account, Alice?
Debit.
Debit. So when we are writing the expenses, we will send this increased figure there because we have lost. We cannot bring it to other income. Are we good?
Yes, sir.
Hey, are we good?
Yes, sir.
Are you writing?
Yes, sir.
Yes, sir.
Yo. So let me write. Decrease in allowance. I'm tired. It's be what? 22,500 minus what? The 5%. So minus into brackets 5% on the what is the receivables figure? 248,400. And how much was it? How much do you have? How much do you arrive at?
10,080.
I believe you guys understand this.
Yes.
That's it. That's all. So add all the three for me.
Mm. Mm. Yeah, 51,000.
What?
351,000.
51.
Thousand.
What else? Is that a
Yeah,
round figure?
that's a round figure, 351,000.
What is the name for the 351,000?
Total,
We said
Total
we will
income.
find other income and add it to the gross profits.
yeah, so it's total income.
So we've added the two other incomes. We've added it to the gross profits. So what is the name of this 351? Total income. Do you
Total
agree?
income. Yes.
Yes, sir.
So you are done with total income. What is the next profit?
Yes, yes, yes,
What is the next level of
Total
profit you have to
in
solve?
total income
What
minus
is the next profit we have to
operation.
solve? Yes?
Total income minus operating expenses.
No, 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 no. What is the net profits level we have to solve for? It's not net profits.
Yes, sir.
That's the third. We found gross profits. We found total income. What's the next level of profit we have to finally solve for? Net profit or
Net
loss.
profit. Yes.
Then how do we get the net profit or loss?
Total income
Total
minus
income minus
operating
operating
expense.
expenses.
Do we have the total income there already?
Yes,
Yes,
sir.
sir.
What are we to bring?
Operating expenses.
So we
Yes,
go.
sir.
And operating expenses, T account, where does it fall? Alice, T account.
Credit side.
Hey,
Credit. No, debit. Debit.
it's an expense.
Debit.
Don't
Debit.
be, don't
It's an
be,
expense.
don't be confused by the operating. Expense. Don't master that Alice. So master the Alice. Those who are doing
Debit.
admin and their banking and finance and actuarial science and real estate, master the Alice. You'll be using it a lot when it comes to accounting and even finance. Master it a lot. Let it be on your fingertips. Everything expenses debits. Just master. I don't think you know. Master it. I wish I'm not using my tablet. I'd have showed you something. I'm not using my tablet. I've showed you something. Yesterday, I was teaching some lady chartered accountant candidates. She's in the final level. I was doing double entry. She was not getting it. I came to Alice. Alice, I used to teach a lot of people, not only you. So, master, I don't think you know. Just learn it. Be humble and go and learn. She said, I don't have my tablet. I was sitting on my tablet. I'll show it to you. I went back to the way I started saying, what's the name that I used James, right? I said James purchased 500 CDs. Did I use five? No, 305 CDs worth of
300.
goods. You remember when we were solving, I was using this when we were doing correction of errors.
Yes, sir.
And that lady, she's done with her masters, and she's doing chartered accounting. And when I was teaching her, she was not getting a double entry. I had to come to Alice. I had to come here. Then I use a similar example like Kofi. For her, I use Kofi and sales account. And I just showed her how to use the Alice. That was all. So go and learn it. I don't know why you have to be making mistakes. When I ask you, this is operating expenses. Expenses. There are so many expenses. So operating expenses, where does it fall? T account, Alice. Just know the first A and E falls on the debit side. Don't joke with it too. She's one of my girls. Yeah. She's done with a master's undergrad, UG, done with a master's. She's doing chartered accounting. I was teaching her yesterday. I had to come down to Alice and teach her basic accounting like I'm teaching you. Before she got the double entry right, I have to do practice. I solved 3 different examples, wrote 3 different transactions, like the way we are doing correction of errors. And I'll do the double entry for the first one. She did it for the next 2. She got it right before I went to teach her the difficult thing, that more advanced accounting. So don't forget it. So do you have the total income there?
Yes, sir.
What else do you
Yes.
bring along? What else do you need to bring?
Yeah.
Operating expenses.
Operating expense.
Then operating expenses. Alice, where does it fall on the T account?
Debit.
Debit
Yes.
side.
Debit.
And because we are moving it from the debit side to the income on the credit side, what would the operating expense, what will it become? Positive or negative?
Negative.
That is why we are subtracting. That's why we are subtracting, because they are changing sides. And I'm sorry, whenever they change sides, they will subtract. When it moves from debit and goes to credit, it's going to subtract. When it moves from credit and goes to debit, it's going to subtract. So now we have our total income. For us to get the net profit, the name is called what? Statement of profit or loss. So for us to get this profit or loss at the end, which is the last level of profit here, net profit or loss, we have to go and bring the operating expenses. So let's go and bring the operating expenses. So we'll say less operating expenses. Do you get it?
Yes, sir.
When we are going to bring the operating expenses, we will start from the top of the trial balance. Land and equipment. Land and equipment. When we wrote the footnotes, which footnotes was linked to land and equipment?
Depreciation. Or use.
When we wrote the footnotes, which footnote numbers were linked to land and equipment?
The V.
Depreciations, the V, right?
Depreciation.
So I'll
Yes.
start.
Yes.
It says land has no provision, so there is no depreciation on land. This land is called a freehold land. There is no depreciation on land. If it is a leasehold land, sometimes we can compute depreciation. Depreciation on land. This is a freehold land. Depreciation. So we will not compute anything for depreciation on land. But you come to where? Equipment. Are you good? What is the formula for the equipment depreciation? It says 15% reducing balance. So watch. You will say 15% times, what is the cost of the equipment?
Equipment.
404,000, right?
Yes.
Minus, what is the accumulated depreciation on equipment?
65.
55,600.
So minus 65,600. What's the final answer? Just as you see, compute it like that on the calculator. Don't change anything. Let's be quick. We are almost done. We are almost done with the first part.
500 and no.
So 15% times into brackets 404,000 minus 65,600. What do you have?
50,760.
760.
760.
Pay attention. Now, so we are done with the depreciation part of the equipment. Let's go to the next one. What's the next one? Have we dealt with accumulated depreciation? Yes.
Yes.
Have we dealt with inventory? Yes.
Yes.
It's not coming back. If you've dealt with it, it's not coming back. Also, we are not going to record the 240,000 in the P&L because land is an asset. Asset doesn't come in here. Now, watch here. I'm still coming back to the Alice. Watch. Alice. The I and the E. The I and E. They are used to prepare the P&L, profit or loss statements, P&L statements. Then the A equals L plus C. The ALC is used to prepare the balance sheet. So when we are going into the P&L, we are only looking for items which will bring us income or expense. Income, expense, income. Sales is an income. Then we took out cost of sales, it's an expense. Then we got gross profits. Then we added an additional income, other income. Then we got total income. Then we have total income. We are also going to take out expense, which are the operating expenses. So we get a net profit. So that's how the P&L is structured. Income, subtract expense, income, subtract expense, income, subtract expense. That's all. But when they take the remaining three, ALC, we are using to prepare balance sheets. So items in the trial balance, which are assets, they don't reflect in the P&L because they are not income. However, when we have an asset in the trial balance, we can examine or we can evaluate to see whether any regular expenses can be incurred on the assets, like equipment. Equipment is an asset. But what expense can be incurred on the equipment? Equipment repairs. It can come to the P&L. What other regular expense can be incurred on the equipment? Depreciation. That is why, although equipment is an asset, we calculate depreciation on the equipment because the depreciation is a revenue expenditure. Though it's a non-cash flow, though it's not a cash money, it's not a cash expenditure, but then it's an estimatable expense. Are you getting it? So when it comes to the equipment and land, equipment, we have to calculate depreciation on it. That is the expense we can derive from the equipment, the regular expenditure or the periodic expenditure or the operating expenditure we can incur on the equipment. Meanwhile, the actual cost of the equipment, which is the 404,000, it is an asset. And where do we record assets? In the balance sheet, not in the P&L. Do you understand what I'm saying?
Yes.
Yes.
Uh-huh. So equipment and land, they are all P&L. Accumulated depreciation is a liability. We'll take it to P&L because we said that the ALC, the liability here will go to be a balance sheet. But it's the accumulated depreciation helped us to compute the depreciation for this year. Accumulated depreciation means that depreciation which has been piled up from the previous years. It has been piled up from the previous year. So last year, last 2 years, we don't know when they got the equipment. So all the depreciation for each year, let's say if this asset is 3 years old in the organization, the first year they bought it, what was the depreciation? They will write it down. The second year, when they use the equipment, the depreciation also, they will charge it and they will add it to last year's own. There's previous year's own. So we will have depreciation for 2 years. Then when they come to the third year, they will charge depreciation for that year and add it to the 2 years depreciation. So so we say that the depreciation has been accumulated. So accumulated depreciation. Do we get it?
Yes.
Do we get it?
Yes, sir.
Only one person.
Yes, sir.
Okay. Am I over explaining?
No.
Yo. Inventory. If we have already used it, we will not touch it again. Inventory, opening inventory, we've used it. It's up here. Are you getting it?
Yes, sir.
Receivables and payables, they are all balance sheet items. We don't touch them. Bank and cash, balance sheet items. Allowance for doubtful debts, we have dealt with it already. We've gotten the decrease, so we don't touch it. Business rent is the next one, is the next expense. Business rent is the next expense. So we come here and we say business rent. Is there anything on business rent in additional information?
Yes. Annual rent.
It says what? Here, I. That's why you have to write the footnote against them. Right? It says, our buyer has agreed on an annual rent of 80,000 with his landlord. So, out of the 80,000, how much has our buyer paid? Out of the 80,000 which he has agreed with the landlord, how much has our buyer paid?
60,000.
60,000.
60,000. Pay attention. So, if you have agreed with 80,000 with your landlord and you have paid 60,000, how much do you have left which you haven't paid?
80,000.
20,000.
20,000.
So, 80,000. The 20,000 or buyer hasn't paid. It is called accrued expense. You are owing 80,000. You have paid 60,000. Means you owe 20,000. So write this down. In the footnote, when you read words like accrual, when you read words like accrual, accrued expense, accrued, whatever accrued expense, it can be accrued utility, accrued rent, whatever it is. When you see words like outstanding, when you see words like owing, when you see words like yet to be paid, they all mean accrual. When you see word like owing, okay, I've written it. So accrual, accrued expense, outstanding, owing, yet to be paid, pending. When you see all these words, they mean that that expense is not paid yet. They are owing. They have not yet paid it yet. How do we treat it? I said footnote items are treated how many times? Hey,
Twice.
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 So in the P&L, you add to the expense in the P&L. You add to the expense in the P&L. So if there's accrued rent, when you go to the rent in the P&L, in the trial balance, you add to that rent in the trial balance, right? Then in the balance sheet, or let me write it this way. You treat it twice. So in the P&L, add to expense. There's add to expense. Then the balance sheet, right? You add to current liabilities, CL. That's how you treat it. Whenever there's an accrual, anything accrued or outstanding, or yet to be paid, in the P&L, you would add to the expense. So you add to the expense in the trial balance. Good. Add to expense in the trial balance in the P&L. So you bring the expense like this one. You bring the expense in the trial balance. Then you add the accrual. So 60 plus 20 gave us what? 80,000. Are we good?
Yes, sir.
Hey, are we good?
Also,
If you are tired, I'm more tired than you. I'm not writing your exam tomorrow. So let me finish it for you, then you can go. Then, when you see words like prepayment, prepaid, paid in advance, we are going to see more often. Already paid. They all mean the same thing. They all mean prepayment. Prepayments are like gains. They are like gains. Right? They are for the subsequent year. So what we do is that in the P&L, they will always appear in the footnotes. In the P&L too, you subtract from the expense in the trial balance. Subtract that prepayment expense from the associated expense in the trial balance. So assuming we have prepaid insurance or prepaid utility of 200, and we have another utility in the trial balance of 500, I'll just write when I'm preparing the operating expenses, I'll write the one in the trial balance first, which is the 500. Then I'll say prepaid utility 200. I'll subtract it. Are we okay?
Yes, sir.
Then in the balance sheet, you add to current assets. I'll be asking you, so make sure you write it and understand it. I'll ask you, this one, is it prepaid? Yes. How do we treat it here? You tell me, I'll write. This one is this. How do you treat it here? You tell me, I'll write it. Are you finished writing?
No.
Accrual is the same as accrued expense, the same as outstanding, it's the same as owing, it's the same as yet to be paid, it's the same as pending. P&L, add to expense in the trial balance. Balance sheet, add to current liability. Are we good?
Yes, sir.
Prepayment, prepaid, paid in advance, already paid. P&L, subtract from the expense in trial balance. Balance sheet, add to current assets. Are we good? All right, let's continue. Hey, people are leaving. Okay, let me finish quickly. So let's go. So it means that in the 80,000 which is recorded, the woman has paid 60,000 and 20,000 is outstanding. So it's owing. So we add it. It's an accrual. We add it. That's why we get the 80,000. Let's go. What's the next? Purchases. Have we dealt with purchases?
Yes, sir.
Yes. So we don't repeat it. Returns. Have we dealt with both of them?
Yes.
Yes. We don't repeat it. Distribution and advertising. So we record it here. Distribution and advertising. How much was it? 17,800. 17,800. Then what else? Discounts. So the discounts, we recorded discount received already. The one on the credit side is the received. So the one on the debit side is allowed. So discounts allowed. How much was it? 8,400. There we go with communication. How much was it? 30,080, right?
2008. Yes.
Then we go with what? Insurance. What is insurance? 45,000. But the one in the what is insurance in the trial balance saying? Included in the insurance above is an amount of 5,500, which relates to 2021. Which year financial statements are we preparing?
2020.
And the insurance is for 2021. So is it accrual or prepayment?
Prepayment.
They have paid in advance to 2021. So we say prepaid insurance. How much is it? 5,500. Do we add or we subtract prepayment?
Ah,
Do we
Add.
add or subtract prepayment?
huh? Yeah,
Hey,
So
Subtract.
we
subtract from the
subtract.
account
Hey,
balance.
I just
Yes,
gave you notes.
because
Bema, be careful. I just
yeah,
gave you
yes,
notes
I
here.
just
Are you sleeping?
no.
Okay, let's go on. So we are done. Prepaid insurance, wages and salaries. Do you have any information on wages and salaries?
No.
128,760. Have we dealt with sales? Yes, we don't touch it. Long-term loan is a liability. And I've showed you that anything on assets, liability, and capital, they go to balance sheet. Don't touch them. Long-term loan is a liability. Loan interest paid. This one, you don't touch it. We will take it we will deal with it when we get to the current liability. But we cannot touch the long-term loan because it's a liability. However, we can compute the interest on the loan. Interest on the loan. And the interest on the loan is 10% of what? The 364,000. You know, whenever you're going for loan, they will say this per annum, right? You are paying 5% per annum. Have you ever heard that before?
Okay.
So that per annum means every year we have to compute interest. Then when you compute, what do we have? 36,400, right? Are we okay?
Yes, sir.
So the
Yes.
10% long-term loan, it will go to the balance sheet, but the interest on it is an expense. We are interested in the interest on the loan, not the amount, not the entire amount. So 10% on the 364 will give us 36400. Then the loan interest paid, we will not touch it. We will take it when we get to the current liability, we'll deal with it. Then we have bad debt. What is the bad debt figure? 4,480. Drawings, it goes to balance sheets. Capital, it goes to balance sheets. We don't touch them. Now let's go to additional information, whether we have captured everything in the additional information. Have we captured closing inventory already?
Yes.
Yes.
Our buyer has agreed on annual rent. Have we captured the annual rent already?
Mm.
Yeah.
Included in the insurance above is an amount of 5,500, which relates to 2021, prepaid insurance. How do you know it's prepaid insurance? We are dealing with 31st December 2020 this year, and they have paid money into the following year, next year. So they have paid in
So she doesn't know
advance.
the way, so I asked her directly.
Airtel. Hey, let me mute her. Where is she? She has muted herself. So we are interested in the accounts for 2020, but they paid an amount of money which belongs to the following year, which is 2021 in 2020. So we'll take it out. It doesn't relate to this year, so we'll take it out. Are you good?
Yes, sir.
So we have captured it. It is here. Where is it? Where is it?
Yes.
It's here. Our buyer makes 5% provision on the receivable balance at the end of each year. We've done it. When we calculate for the provision, we compare with the allowance to know whether there's an increase or decrease, and we got a decrease, we added it to other income. Depreciation is to be charged as follows. We've calculated the depreciation. So it means we are done. So I'll underline all my operating expenses. Add all and give me the total. I'll put the whole total here.
Sir, from this depreciation equipment.
Yes, 760, 80,000, 17,800, 8,400, 30, 80, 45,000, 5,500, 128,000, 760, 36,400, 4,480.
Sir, 369,180.
Who got that also? Who got that also?
Yeah, 369,180.
187.
80.
Okay. So it's an expense. We will less it. So from the 351,000, what do we have?
$18,180.
18,000.
180.
180. This.
Yes.
Positive or negative?
Positive.
Wrong.
Negative. Negative.
It's a loss. It's
I'm the one who
369.
subtract. Yes,
Just
the
make
loss.
it
Yes, negative.
351,000 minus what you see. So 18180 is a loss. So we got a net loss. Then you double underline the figure. So have we finished our last profit level? Yes. But we got a net loss. Is it difficult?
No.
Is it difficult, class?
No,
No.
sir.
Practice. It's just practice. I've spent so much time, like 2 hours explaining. I don't do that normally. I can just solve it quickly and we'll finish. Now, you go to the next sheet. You go to the next paper. the next page. Then we go and solve the B. The B says what?
Statement of financial position.
So you write the
Okay.
entity's name again. What's the entity's name? Another part. Then write B. Statements. So the question says what? Prepare a statement of financial position as at 31st December 2020. So you say statement of financial position as at 31st December 2020. Then here you write costs, you write accumulated depreciation, ACC depreciation, then you write net book value.
Hmm?
You write costs,
Salary,
accumulated
salary.
depreciation, net book value. Then you come with Ghana City here, Ghana City there, Ghana City there. Then you start. Watch. We are now preparing the balance sheets. We are following this approach. Asset is called accounting equation. Asset equals liability plus equity. That's what we are following, or we are following that pattern to prepare. We are following that pattern to prepare the balance sheet. Asset has two parts. What are they? Now, those who you have not watched the intro to, I can go and watch it on the YouTube channel.
Non-current assets and current assets.
Then liability also has two parts. What do we have? Non-current liability and current
Non-current
liability.
liability and non-current liability.
So I want to find total assets. So I'll first find non-current assets. So assets here, I'll find non-current assets. Are you good?
Yes, sir.
Then the non-current assets, I'll go to the question and search for the non-current assets. We have land.
Land.
We have equipment. They are non-current assets. Let's look at this question. Look at this question. In this question, the non-current assets. In this question, the non-current assets, premises, they use premises. Premises is building. So they have equipment. It has motor vehicle. They are all non-current assets. Right?
Yeah.
I can write all of them under non-current assets. Then I'll write their costs. Their costs are these figures. So this is the one for equipment. This is the one for motor vehicle. This is the one for premises. Then when I go to the accumulated depreciation, this is the one for equipment. This is the one for motor vehicle. Are you okay?
Yes, sir.
Are we okay?
Yes, sir.
Hey, am I teaching only one person?
Yes, sir.
Yes.
You be there and be sleeping. Yes, sir. Yes, sir. Yes, sir. Be there and be sleeping. Okay, let's continue. So here, land. What is the cost of land?
240,000.
40,000.
So 240,000. Is there any accumulated depreciation on land? No. So
No.
cost minus accumulated depreciation, what do we have? 240,000.
240,000.
So, sir, they will give you their own accumulated depreciation.
They always give it. If they don't give it, put dash there. What is the cost of equipment? 404,000, right?
404,000. Yes.
Watch. What is the accumulated depreciation on equipment?
15% reducing balance.
Hey. Who is that? What is the
here.
accumulated depreciation on equipment?
65,600.
65,600. Then we will add the depreciation for this year also. What's the
Which we
depreciation on
have
equipment for this year?
50,760.
We will come and add it. 50,760. So you say on your calculator, you make it 404,000 minus 65,600 minus 50,760, or 404,000 into bracket minus into bracket 65,600 plus 50,760 bracket close. We have to subtract both depreciations from the 404,000. What do we have?
287,640.
What?
287,640.
Is that all we have on the assets?
Yes.
Okay. So we will close off. 240,000 plus 404. What do we have? We have 644,000. Then the 65,600 plus 0, negative 0, negative 65,600, or 0. The first one is 0. So 65,600 plus 50,760. What do we have?
116,360.
100 and what?
16,360.
So whenever you get to this point, pay attention. You will do a vertical calculation. You add both of this. Then you subtract the accumulated from the cost, total cost, to see whether you get the same value here before you write your answer. So someone should add the vertical NBVs.
The vertical one is 527,640.
527,
640.
8.
640.
Open your mouth.
640.
You're a man. You are not a lady. Open your mouth. Then someone should also subtract the 116,360 from 644,000. What do we have? What do we have?
The thing.
Is it the same?
Yes, sir.
So you then write it. Don't do one side and go and write. Confirm before you write it. They must be the same.
Versus 64.
So we are done with this 527,640 is the total non-current assets. So for us to find total assets, what and what do we need?
Okay. Liabilities.
Defines for
We want to find total current assets. Total assets. We found non-current assets. What are we left?
Current assets.
Current assets.
And somebody saying liabilities. I will head you. You joke with me. I'll give you a headbutt. Headbutt. So that when we add this to this, we get the total, right? So the total current assets, you go to the additional information, the closing inventory there. Are you following?
Yes.
Yes, sir.
So you write closing inventory. What's the closing inventory figure?
Closing inventory
84,000.
84,780.
84,000.
780.
80.
Then we will go receivables. What is the receivable figure?
Receivables 248,400.
Then you see there is something on the receivable in the additional information, right? Provision on the receivable, this side. Have you seen it?
Yes.
So you come and write provision on receivable. It was 5% times what? The 248,400. Do you remember?
Okay.
What do we get? What do you arrive at?
Okay.
5%.
What do we have?
12,420.
What?
12,000.
12,420.
You subtract. You subtract. Are you good?
Okay.
Guys, are we good?
Yes, sir.
Okay.
Then you come to the prepayments. Was there any prepayments? Prepaid what? What did the business pay? What payment belonged to the following year but was made this year?
Accruals. Yes, accruals.
Watch, no, prepayments. I. Included in the insurance above is an amount
Insurance.
5,500, which relates to what?
2021.
21.
Which relates to 2021. So we are reporting in 2022. But then they've made a payment in 2021. That's they have paid before the year, the start of the year, right? They have paid in this year what they should have paid next year. So they have paid in advance. So it's called prepaid. So you write here prepaid insurance. Why are we adding it to current assets? So that it means that when the business enter the next year, that insurance they will not pay. Are you getting it? Because they've already
Yes.
paid it in this year. So it's an asset to the business next year. So we
Oh,
say
okay.
5,500, you add it. Then we will come to, now let me explain this one. Watch here, this figure. See that we didn't use the decrease figure here. We use exactly the 5% on the provision figure. We didn't go and bring the decrease. The decrease we sent to the P&L. We didn't bring that figure there. So let's look at it. So we didn't bring the 10,088. We didn't send that figure there. We rather send the 5%, which is in the additional information, the end of year value, the closing balance on the provision for receivable. That's what we took to the current assets. Are you getting it?
Yes.
In the
Yes,
P&L, in the trial balance, this allowance for that is the opening balance. And the 5% general provision is the closing balance. That is what we took to the current assets, not the decrease. Do you guys get it?
Yes, sir.
Okay. Let's go on. So after the prepaid insurance, we'll go to bank and cash balances. Bank and cash balances. How much is it? 31,280. We add. Are we good?
Yes, sir.
Yes.
Add everything. And I'll put the total here.
Three, 5, 7, 5, 4, 0.
Who got that? Who got the same
Okay.
figure?
Yeah.
So we add. Why? We want to find assets. We have to, asset is into two categories, or it has two branches, the non-current assets and the current assets. So when we add both of them, they will give us the total asset. So we have to add, don't subtract. Yes, what do we have? What do we have?
885180.
8851.
5180.
This is called total assets. So we write here total assets. So here, the assets, we have 885180 equals. Now, look at the accounting equation. What else are we left to find? We have to find capital and liabilities, right?
Yes,
So let's find the capital first. So I come down. Then we say capital and write it in full. Don't write the end as I've written it. And liabilities. So we bring the capital in the P&L, in the trial balance. Capital, what's the capital figure? 303,460. Are you getting it?
Yes.
Then we'll bring the balance on from the income statement. We got a net loss, right?
Yes.
Of what? 18180. Right?
No, 18180.
So 181?
Net loss.
Was it 18180?
No, for net loss.
Yes, 18180.
18180. So you bring it to the capital. You come and it's a loss. So you come and write the same thing here. Net loss. 18180.
Okay.
Then the drawings. Look at the drawings here. You bring it also. You come and subtract drawings. 21,160. When you subtract everything, what do you have? Quick.
264120.
264120.
Now, this is the total capital. So we've gotten the capital. What do you get for the capital? 264120. What else are we left with? The liabilities, right?
Liabilities.
The liabilities, there are two parts. We have the non-current, right?
Yes.
Yeah.
So let's go and work on the non-current. So we come down. Non-current liabilities. So non-current liabilities. What is the non-current liability in the question? The loan. Long-term loan is the same as the long-term liabilities. So you just copy and paste 10% long-term loan. The figure is what? 364,000. Then we come. So that's the only long-term loan. What other? So that's only the non-current liability. What is next? The current liability, right?
Yes.
So we can write here current liabilities. The first item is the payable. Trade, so I can say trade payable, account payable, whichever payable. What's the figure? 208,760. Then you go to all the accruals. Are you following? Our buyer has agreed an annual rent of 80,000 with his landlord, and our buyer pays 60,000. So how much had our buyer left to pay?
20,000.
20,000.
So that you say accrued rent. She's owing the rent or rent owing. 80,000 minus 60,000. Where owes 20,000. She hasn't paid. Then we go and look out for the interest on the loan. Interest on loan. How much was the interest on loan? How much was the business owing on interest on loan? Let's go. What is the interest on loan here?
$36,400.
36. Have you all seen it?
Yeah.
Okay. Let me write it very simply for you. So the interest on loan, we will write it again. 36,400. Then the loan interest paid. This. So they owe 36,400, but within the year, the business paid some. Are you getting it? Are you getting it?
Yes.
Okay.
They owed 36,400. That's the interest on the loan, which they have to pay at the end of the year. But within the year, business paid parts. How much the business pay? 9,100. So you subtract it. Or you can simply write it as what? Interest on loan. Into bracket 36,400 minus 9,100 to know how much the business actually owes to pay. Which one do you prefer? Is it the first or the second one?
The second one.
Do you prefer the first or the second method? Do you prefer these two or the second one? Quick. Do you prefer to write it this way or the second method? Which one?
First.
Okay, let me see if there's any other thing else. Okay, I think that's all. Okay, let's add everything. What do we have?
$230,060.
238,000 what?
And 60.
Who got this? Confirm.
I said it's a mistake.
Be careful.
Sorry. It's 256,060.
Who got this? Confirm this. Please confirm. You're almost done.
Sir, please, for which one?
Confirm.
Sir, please, for
Confirm
which
the
one?
current liabilities. Confirm the total.
Current liabilities and the capital together.
Yeah, it's two. No. Just the current liabilities.
Current and non-current together or something.
No. Current. Only the currents. Is that figure correct?
Sir, please, I'm coming.
Yes,
So it's
correct.
256060.
So add
Yes,
all the
correct.
three figures. Add one. So watch. This is what we are doing. We have NCL to be what? 364,000.
Yeah.
Then what is our CL? 256 and 60.
256060.
So we are adding all these three. We should give us the same figure here. If it doesn't give us, it means that there was a mistake somewhere. So
Yeah, I
out of
can
the
see the
three,
down.
we had what?
885180.
So all these three gives us 885180. So the total debit, all assets are on the debit side. And the Alice, this Alice there, if you don't learn it, you have no idea. The assets and expenses are on the debit side. Then the LIC are on the credit side. And we use the I and the E to prepare the income statement. So the remaining three, the ILC, it must still balance. The remaining three must still, so asset is on the debit side. L and C are on the credit side. So after that, the debit is 885. The credit also is what? It has balanced. So that when you subtract both, you get 0. Accounting is Alice. So if you don't have a girlfriend, go and find a girlfriend called Alice. And your life will balance forever. So this figure here, this 885180, it took capital and liabilities to give us that figure. So we will say total capital and liabilities. We are finished. Now let's do some few verifications. We want to find out whether all the items in I to V, whether they reflected, whether they were treated twice. Inventory, were they treated twice?
Yes.
Oh, wow, it's missing. Okay, I found it. Inventory, were they treated twice?
Yes.
Yes.
Let me use a different highlighter. Okay, this is okay. So let's see. Inventory is here, closing inventory is here. In the balance sheets, let's check the P&L. It's also here. Twice, right?
Yes.
Okay, let's go. Our buyer has agreed an annual rent of 80,000 with his landlord. The 80,000, the portion of the 80,000 which was accrued was the 60,000. Was the 20,000 because our buyer had paid 60,000 already, right?
Yes.
Right?
Yes, sir.
So the 80,000, the 20,000, was it treated twice? Yes. We saw it in the P&L and our business rent, and also we've seen it in the here. Do we see it? Do we see it?
Yes.
Has it been treated
Yes.
twice?
Yes.
Yes.
Even if you want the 80,000 itself, this is the 80,000. This is 80,000. And in the P&L too, the 80,000 is there. This is 80,000 in the P&L. So it's still treated twice. Including the insurance above is an amount of 5,500. So 5,500, which relates to 2021, is a prepayment. So this is it, 5,500. First time in the P&L. When we come to the financial position, 5,500 prepaid. Obaya makes 5% general provision on the receivable balance at the end of each financial year. So 5% provision, general provision. There's a 5% general provision here. There's a treatment in the balance sheet. 1. Let's check the P&L. In the P&L 2, where is it? Here is it in the P&L. Another treatment. So it has been treated twice. Depreciation. Has it been treated twice? Land has no depreciation, so we'll not touch on land. Equipment, this is it, the first one. 5760. This is it again, the second time in the accumulated depreciation. Are we getting it?
Yes.
All other items in the trial balance, they were treated once. All other items here, everything in the trial balance, they were all treated once. If it appears in the P&L, it will not be in the financial position. If it appears in the financial position, it will not be in the P&L. What you must learn is that there are some of the items, they are straight away balance sheet, like land, equipment, accumulated. They will go there. That one, you take their full figures there, they will be shown. Look at land, the full figures are shown. But in the P&L, we were only calculating the expenses on them. Equipment, we calculate the expense on equipment, which is the depreciation. We didn't use the 404,000 entirely. We only calculated the depreciation on it. But in the balance sheet, we use the full figures, the total figures. The bank and cash, we didn't use it in the P&L. We use it in the balance sheet. Receivables and payers, we didn't use them. We only calculate the 5% on the receivables, just the 5%. But the full figures, we use them in the balance sheet. Discounts is a P&L. We have to note. So when you are solving them, we have to know those items which are like P&L straight and those which are balance sheet straight. Long-term loan is a balance sheet, but we have to only calculate the interest on it, which was the interest on loan, which was the expense. Drawings is P&L, is balance sheet, capital, balance sheet, bad debt, balance sheet. Are you good? When you come here to this next question, capital, you know capital is going to balance sheet straight. Cost, equipment at cost, is this one is a full balance sheet, but we may calculate depreciation on it. Accumulated depreciation is balance sheet. We use the full values. We come and write them here. Cost, accumulated depreciation, net book value. Premises is the building, balance sheet. There is no depreciation on it, unless the question says otherwise. Inventory at is the opening inventory. Bank, balance sheet. This inventory is the P&L. It comes to purchases. And I said that when it comes to the cost of sales, the opening inventory is added, the closing inventory is subtracted. Sales is an income. Purchases, then trade receivables, straight away, balance sheet. Trade payables, balance sheet. Carried inwards, we will add it to purchases in the cost of sales. Carried outwards will go to operating expenses. Carried inwards is carrying the goods into the business. So you went to buy, so they are carrying the goods into. So the carried inwards go in line with purchases. Then carried outwards is when the business is carting or escorting or accompanying a customer with the goods. So that one is operating expenses. Returns, the one on the debit, always learn the one on the credit side, or the one on the debit side is inwards. The inwards one is used against sales because sales is on the credit side. Then the outwards one is used against purchases. Investment, this one, if I were to write it here, I'll add it to current assets. This one. After the bank and cash, I'll write investments. 120,000 on the current assets. You can also add it to the non-current assets, but here I'll add it to the current assets. Discounts, debits, allowed. Always know for one. Know the received is a gain, it's an income. So if the received is a gain, then the next one, which is the allowed, is an expense. That's how we treated it. So you'll be seeing the same thing we've treated in your questions. You should know where they belong. Wages and salaries is an expense. Rent and rate an expense. Insurance an expense. You know, we saw insurance there. We saw wages and salaries. So don't go and take wages and salaries and take it to balance sheets. How on earth will you do that? I've explained. Telephone expenses is an expense. Expenses. Irrecoverable debt. Another name is called the bad debt. We used it in the previous one. Just this one. Bad debt is an expense. Allowance for receivables. You know how to treat allowance for receivables. You come and compare it with the V. Allowance for receivables is what? 5% of receivables. Just like the one we solved. You calculate 5% on the trade receivables, which is 258,000. Then you compare with the one in the trial balance. If there's an increase, if at the end of the year it has increased, you take it to expense. If at the end of the year it has decreased, you take it to other income. All right. Then income from rent is received and income from investment. You take all of them to other income. Inventories, closing inventory. Insurance includes 613 for 3 months, ended 31st January 2021. We are in 2020. We are preparing reports for 2020. They said 2021. This insurance is called prepaid. Prepaid. You just take the whole figure. 1680. You deduct it. What do we do to prepayments? We less from the expense. Then we take it to the current assets. Prepaid insurance. We go and add it. Prepayments, we subtract, we add. Rent received includes an amount of 4,680 in advance. Assets. So they paid 4,800 in advance. You go and subtract from the rent received. They also add it to the prepaid rent. So yeah, I'll have prepaid insurance. Now I'll have prepaid rent. I'll put them there. Because it belongs to another year. Salaries of 1,500 were prepaid. And telephone, like so, the salaries advance, which is 1,500, I'll go to the salaries account when I'm writing the operating expenses, and I'll less it. I'll say prepaid salaries, I'll less it. When I come to the current asset, I'll have prepaid insurance, prepaid rent, prepaid salaries. Then telephone expense of 1,000 were owing. You see the way they use, they didn't use accrued, they didn't use pending. Now they use outstanding. They said we're owing, so it's accrual. So you add it to the telephone expenses in the trial balance in the P&L, to the trial balance in the P&L. Then you take the accruals to non-current accrued rents. There will be accrued telephone expenses. Allowance for receivables I've explained. Depreciation. You compute on the equipment and the motor vehicle. On cost means you multiply 20% times the cost of the equipment. That's straightforward. So the cost is 700,000. Equipment on cost means, I'm talking about this side. You just say equipment, depreciation, equipment. You say 20% times the cost. What's the cost? 700,000. 700,000, that's it. Which will give you about, is it 140,000 or so? That's it. But if it's reducing balance, we'll solve around reducing balance for you to see. That's all. Is it difficult?
No.
Go and practice. Practice and practice and practice. And just follow the way I explained it. That's all. You'll be okay. 3 levels of profit. Gross profit, what do we do? Total income, net profit or loss. That's what we need this one. This is the one we need. But before we can arrive at that one, we have to go through the first 2, which will lead us to the last one. Then this is for the P&L. When it comes to the balance sheet, we use the, what's the name? We use the ALICE, the ALC. The I and E was for the P&L. The ALC are for the balance sheets, the accounting equation. You find a non-current first, you go and find a current, then you go and you find a capital, then you go and work on the NCL and the CL, you add all together, you get the same thing. In exams, if you are not able to balance, don't bother. If you're able to finish it, if you're able to finish everything, it's 20 marks, 10 P&L, 10 financial position. If you're not able to even balance it and you finish everything, you can be given 18/20. It's better than somebody who didn't do, who just wrote sales and left, who gets 0 over or 1/20 or 3/20 and have a receipt. So try to master the format and the explanation. That is all. So I'm ending the session. And that's all. All the best.